Welcome to Cash Value Private Banking. Cash Value Private Banking is a unique approach to financial growth. Our clients build their own private bank that allows them to compound their wealth tax-free and risk-free for life, guaranteed, without any exposure to market volatility. In today's video, we explore the average annual return myth. Barry is a friend and colleague who heads our bank structuring team. 20 years ago, Barry became a financial advisor because he wanted to help his friends and clients grow their wealth. Barry followed the script. He sold his clients on the idea propagated by Wall Street that an investor who invests their hard-earned money in a mutual fund or major stock index would harvest a 10% average annual return over several decades. Granted, Barry entered his new job just after the tech bubble burst. He understood why his clients' accounts lost money when the market fell. But what he couldn't account for was why the gains the investor was supposed to see when the market went up after the drop were never reflected in their accounts. Barry went to his supervisor for an explanation, but his supervisor spouted the party line. He said, "Tell them they're in it for the long haul." That answer did not sit well with Barry, who knew that his clients were not getting what he had promised them. So he did his own research and found out no investor has ever harvested the average annual return that Wall Street sells, because the idea is a marketing ploy based on a lie. In this video, you are going to learn what that lie is. Then you will know the very real pain Barry and his clients suffered, and you will know why Barry immediately quit his job. Wall Street will tell you that a 50% loss and a 50% gain are equal, that if an investor suffers a 50% drawdown and then a 50% positive return, that they are back to break even. But that just is not true. 50% down and 50% up is a 25% loss. If you start with $1 and lose 50%, you only have 50 cents still working in the market. Then, if you have a 50% profit on the 50 cents, you only make a quarter. So, starting with $1, losing 50% and gaining 50% still leaves you with a 25-cent loss. And guess what? The problem is exponential. The larger the loss, the bigger the profit needed to get back to break even. If you lose 10%, you have to have an 11% profit to get back to break even. If you lose 50%, you have to have a 100% profit to get back to break even. This also means that even small drawdowns constantly compound the problem, every day. Every little fluctuation is continually compounding the negative impact of losses to recovery for an investor. On a macro level, from the high in October 2007 to the low March 2009, investors lost 57% of their buying power. That was a painful reality for anyone with an IRA or a 401k, or simply anyone with an investment in the market. Plenty of people felt that pain. You might be one of them. It took 6 years from the high for an investor to get back to break even. Break even means no profit for the investor. This entire 6-year sequence, from 2007 to 2013, took place below the tech high in 2000. An investor who entered the market in early 2000 did not get back to break even for 17 years. 17 years of no profit. Tell them that they are in it for the long haul? Indeed. What did Wall Street tell you in March of 2013? Wall Street said that in 2007, an investor earned a 3.53% profit. True when measured from December 31st of 2006. At the end of 2008, Wall Street said that an investor lost 38.49%. True, too, measured year end to end. But what happened to the 57% loss? It got hidden. Wall Street does not measure from the high to the low, nor do they consider the impact of the loss. They measure from year-end to year-end, wherever that falls. To Wall Street, the real loss never happened. The loss they do show does not impact profits going forward. It is as if you started with $1 in 2007 and still had $1 in 2008. At the end of 2009, Wall Street said the investor had made 23.45%, inferring that the investor was close to being back to break even. In 2010, Wall Street said an investor was back to break even. But that just isn't true. An investor was still down 20% at that point. At the true break even, 3 years later, Wall Street says an investor had a profit of 168% on a monthly basis from the bottom in 2008 to the true break-even point. So, what are the lessons learned? First, the sequence of returns negatively impacts an investor's wealth. As we learned, it takes a larger profit to get back to break-even. No investor can capture the average annual return that Wall Street sells. All market investments are subject to the myth. So be wary when a broker or anyone else tells you that mutual funds make a 10% average annual return over decades. It's not true. Taxes and fees also have a negative impact. If you add them in on top of losses incurred by the sequence of returns, the 10% average annual return Wall Street sells is more like 3% in your pocket. Once you know that an investor cannot harvest the average annual return that Wall Street sells, then you will have to search your soul to answer a very important question. A question that may make the difference between a comfortable lifestyle in old age versus pain and suffering. The question is, with the current massive government debt, personal debt, and the political turmoil we face today, how likely is it that the economy is a bubble that will burst in the next 10 years? This probably is the most important question we all face today. Often when we meet new clients at Cash Value Private Banking, they are so conditioned by traditional thinking, they believe they have to take risks to grow their wealth. But that just is not true. The solution is not a hot new stock, nor a new investment in another roller coaster market. Our clients don't care about the direction of the markets. They are protected. Their wealth grows tax-free and risk-free, guaranteed for life with no exposure to market volatility. Few people know that private banks have been compounding risk-free and tax-free for over 160 years, through every business cycle, including the Great Depression, both world wars, and the mortgage crisis of 2008. Still, it is a new paradigm for most people. A private bank is a sophisticated and safe way to create a solid financial future that protects your lifestyle now and through retirement, and leaves an amazing legacy for your family. In a free 15-minute consultation, we take all the mystery out of building a cash value private bank. We make it simple, step by step. Reach out now. Our team of professionals will be happy to answer any questions you have about cash value private banks. Request a detailed and specific personal illustration so you will know exactly what to expect if you build your own cash value private bank. You decide if it works for you. No obligation, no pressure, all free. We look forward to speaking with you.